From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last weekend of July. So where did the summer go? Let's check on the first place Milwaukee Brewers, who are home for the next 6 days. First, it's the Marlins, and then the Chicago Cubs. And it's the Cubs' last visit to Milwaukee this year. Thank God for that. Other events include German Fest and some tours of the Milwaukee hometown, like Milwaukee's e-bike and smorgasbord tour. How fun could that be? Or maybe a Milwaukee cheese curd kayak tour. Or how about a Shakespeare in the Mitchell Park? Let's just say there's a lot of stuff happening in the city. The Tallahassee police arrested Chuck E. Cheese. Yeah, that Chuck E. Cheese. His crimes include credit card fraud and simple marijuana possession. The day he was popped by the cops, he was in full costume on his way to get a weed license. The story reminds me of the great moment in my life when my son Mike told me he was too old for Chuck E. Cheese. It's the last time I went. A woman who prefers to remain anonymous for good reason recently complained to the media about the struggles of people with tattoos. In cold weather, she has to wear long sleeves, and the sleeves cover up her ink. And she's afraid her fellow tattooed people will think she's a wimp. Lady, if you don't wear sleeves, either shirt, sweater, or coat in the winter, a wimp will be the nicest thing they call you. And finally, most cat owners dread their little kitty will bring home a dead bird or mouse, as many do. But New Zealand's Leo the cat is different. He steals laundry off the line. Some of the things he snagged are men's silk boxer shorts, work socks, the usual bras and panties, and even a $200 sweater, and a pile of clothespins to go with it. He's become such a celebrity that the residents in the neighborhood feel snubbed if he doesn't steal anything from them. Leo's owner returns the stuff by having a once-a-month showing of his ill-gotten gains in the driveway. Just come by, pick up your stuff, no receipt required. On the podcast today, we have Dave Sandstrom and Adam Baley. And wrapping up the week, here's Joel Driesing.
Well, thanks, Max. We had a pretty good week as far as stocks are concerned. The NASDAQ index went up to 21,108 to close on Friday, and was up 522 points, or 2.5% this week. The broad-based S&P 500 went up 129 points this week. That's 2.1% to close at 6389. And the Dow Jones Industrial Average rose 530 points this week. That's 1.2% to close at 44,902. The 10-year U.S. Treasury started the week at 4.42%, and the yield ended today, Friday, at 4.39%. Since the year began, the NASDAQ is up 10%. That's including dividends, and the S&P 500 also 10%, and the Dow Jones Industrial Average is 7.2%. A note with the S&P 500 is that every day this week it broke a record high. So it's been up 14 times this year. It's closed at a record high. So is there much that we should make of that, Adam?
Well, it's good to see we've had all of those highs in a row. I will point out the obvious. Usually after it goes up, sometimes there's some down days. Not every day can be an up day. And we're starting to see some earnings roll in. Ultimately, what drives stock prices, not necessarily day to day, but long term, is interest rates and earnings. We are really in the meat of earnings season, and that's been driving stock prices both short term, day to day, as the earnings are just released, where we get a sense on what businesses have made in the last quarter, but more importantly, what does their earnings look like in the coming quarters for the rest of this year? And earnings have been a mixed bag so far. You've seen some of the technology businesses, which have done pretty well. Some banks have done pretty well, telecoms, but then some of the industrials, GM, for example, or Texas Instruments or Dow Chemical, where in their earnings announcements they're mentioning tariffs, and it is taking a bite out of earnings and profitability. So it's no longer anecdotal on how tariffs are likely to impact earnings, at least in the short term, if not the long term. GM did the best job of quantifying how much tariffs are really taxing on the business. So far, in just the last 3 months, they paid more than $1.1 billion in tariffs. And they estimate, by their own numbers, that before the year is up, GM is likely to pay $5 billion in tariffs. And that's a lot of money. And for even as a well-run, as profitable business as GM is, they cannot come close to absorbing a tariff that big without it impacting the profitability of their business.
And speaking of tariffs, there were some announcements on trade deals this week with the Philippines and Indonesia, and the big one was Japan. I'm reading that some analysts are sort of guesstimating that kind of across-the-board average is going to be about 15% tariffs, that's going to be kind of a standard. That's kind of what the happened with the Japanese deal, or from what we know of it so far. But I also saw that there were some U.S.-based car makers that expressed some concern that there might be some advantages to Japan, in the automotive field.
Yeah, very true. The big announcement this week, at least on the tariff or trade deal front, Japanese goods are now going to cost 15% more. That's kind of a flat tariff. It looks like that is likely to be somewhere about the floor for all of the remaining deals that have yet to get done. For what it's worth, we got a deal done with Japan, Vietnam, Indonesia, and Philippines. This is kind of the cynic in me, but it really doesn't matter if it's not China, if it's not Europe, and it's not Canada. It doesn't matter. We really got to get those done. Those are the critical ones.
And I think, Joel, we talk about how the markets have recovered since the bottom, I think, which was around April 3rd following the Liberation Day, when the president announced 50% across-the-board tariffs, basically against the world. And we've seen, obviously, that be relaxed significantly. And as you're pointing out, the equilibrium level seems to be settling at around 15% is what some of those targets are at. So it'll be interesting. And Adam, to your point, tariffs are ultimately just a tax. And it's either going to be a tax on the corporation or the manufacturer, or they're going to pass it through to the consumer. So it doesn't go away.
Right, and we don't. And as you pointed out, Adam, we don't know yet the long-term effects. We're starting to see the short-term effects.
Yeah, and the Treasury is kind enough to quantify it for us. The Treasury announced that so far, year to date, the Treasury has collected from American businesses more than $100 billion in tariffs and excise taxes. $100 billion with a B in the last several months. That's a lot of money. And that's a lot of money that's not going to pay workers. It's not going to research and development. It's not going to property, plant, and equipment. Those are things that usually go to boost economic momentum and GDP. But $100 billion in tariffs and excise taxes is what American businesses have paid so far this year.
Dave, we were talking about the S&P having 5 records in a row. You and I talked a little bit about this before. We always talk about that investors, long-term investors, should focus on the fundamentals, earnings and interest rates. And as Adam's pointing out, this is interest rate. It's earnings season. So do we put any more status in what the stocks are doing during these times rather than in between earnings seasons?
I think, Joel, history and the data would point to the fact that for long-term investors, getting in at market records is not necessarily a horrible thing to do, right? It doesn't Adam kind of pointed, it doesn't mean that ultimately tomorrow it has to go down. And so getting at peaks, you have to remember momentum is a powerful source of returns. And so just because you hit a record one day, again, doesn't mean it's going to disappear the following day. So you see over time, momentum builds, records build on each other. It's not unusual to continually for a time period to set some records.
Yeah, I'd love to add to that. Even though domestic stocks here with the S&P 500 or NASDAQ, they've gone up a lot, and candidly, they are expensive. By pretty much every measure, they're expensive, but that's not the case in all of the markets around the world. There's still a lot of well-run, profitable, reasonably priced businesses in other areas of the market, in Europe or in Asia or Japan, and not just stocks, but bonds as well. Let's not forget that you can get about 4% on a money market these days. You can get about 5% on a high-quality short-term bond these days. So there's plenty of opportunities outside of just the narrow scope of U.S. stocks.
And is that something, I mean, we've talked in recent podcasts about maybe it's time to look at the geographical diversity of your portfolios a little more. Is that still the case?
I would say absolutely, Joel. And I think another major impact on that conversation is the weakening of the U.S. dollar at this point. There's a high correlation between the performance of international equities and the strength of the dollar. And we've seen over the last 50 years, during extended periods of weakening by the dollar, you've seen substantial outperformance of international stocks over the U.S. market. And so, not to say that we are necessarily on a large downturn of the dollar for an extended period, but there are things in place right now that are putting considerable pressure on the dollar, and tariffs being one of them, our debt issues being another. So there are reasons to be paying attention to the trajectory of the dollar right now.
And at record highs, that means that stocks domestically are expensive, so it might pay to shop around.
And when we do have, I guess my word here, like kind of a regime change in the dollar, whether it's we've come from 11 years of dollar outperformance year after year after year for more than a decade, and you go back to the years prior to that, it was about 11 years of outperformance for the European currencies over the dollar. So when we do get a change in regime, if you will, it tends to play out not just over months or even years, but it can play out over a decade. And a falling U.S. dollar, while it's difficult, traveling overseas or to other countries because it's just more expensive to us Americans, the trade-off, though, is that as U.S. investors in other areas of the globe, it is a tailwind to all of your non-U.S. investments, and it's a wonderful tool to help make money in some of your non-U.S. funds.
Let's talk about interest rates a little bit. Next week, the Fed meets for its Federal Open Market Committee meetings, and which they use those to determine how to set interest rates. And there's been more news about the Fed lately, the president, the White House, the administration wanting the Fed to lower interest rates. The president took an unusual step on Thursday, actually touring the Fed buildings. They've got an over budget construction project that's been going on there, and there's been some pressure on the Fed to make that more of a management situation. I saw that there was an investment banker somewhere, I think in Colorado, who had sued the Fed to try to get its open market meetings open so that people can actually sit in it and basically trade on what was being said during the meeting as it's happening. But any thoughts on what to expect from the Fed meeting next week?
I think, Joel, it's the Fed is in an unusual position, obviously, with pressure coming from the president. I almost think it's counterproductive from the standpoint, if you really want rates to go down, you maybe shouldn't put so much pressure on someone to do so, because they're in a position where they're supposed to be independent. And if they capitulate, or even if they think it's a good idea to lower rates, they may self-incriminate themselves. So with that being said, I think that they're in a wait-and-see position with tariffs. I think tariffs are putting a lot of storm clouds in the way of really looking at what does the economy need right now? Do we really need relaxed rates? Is inflation under control without tariffs? So I think that's a big piece of this, right?
Because they don't want to reduce rates and then have inflation go up.
Absolutely.
Yeah, I mean, the word I would use is that the Fed is in an unenviable position right now, and essentially they have met their two mandates momentarily. As a reminder, the two mandates that they have: one is stable employment, we still have about 4-point-something unemployment, which is full employment, so that's good. You can cross that mandate off the list. They've achieved it. Inflation, as we look backward, has fallen into the 2-3% range, which is right around their comfort zone. So looking backward, you can almost cross that one off the list. They have achieved it. But we're starting to see signs that inflation is percolating. Not yet really signs that the labor market is weakening, but it points to the fact that they're probably just going to have to be patient, let the data roll in before they really have clarity on where this is all going, and then they'll probably act quickly and with some urgency.
Right, Adam. Yeah, Dave?
I just wanted to make the point, because this is a conversation from today. A client had pointed out to me or commented that they were concerned about what Jay Powell was going to do. And I said, well, remember that even with the president asking Powell to make a decision, it isn't Jay Powell's decision independently. And I think that's really important. I think the media is also at fault here, making it sound like it's President Trump against Jay Powell. Yes. He's one of 12 Fed board members that are all voting and all have input on rates are going. So don't be too concerned that this is an all or nothing deal with one individual directing the monetary policy.
He may run the meeting, but their votes are equal.
Yeah, it's the Federal Open Market Committee. Yes. It is the committee collectively that makes the decisions.
Right, yeah. And, in terms of economic indicators, we keep seeing that things are maybe weaker than they were, but they're still pretty strong. One report this week was from the Conference Board on the leading economic indicators. They showed that if they measure their index over a 6-month period, that it was declining at a rate of 2.8% the last 6 months. The 6 months before that, it was declining at a rate of 1.3%. So it's actually worsening. They saw they have a trigger in there for a flag that says that a recession may be imminent. And the third month in a row, that flag went up. And yet the Conference Board economists said they're not calling for a recession yet. They don't see one that's imminent. But as we were saying before the show, there's going to be recession inevitably. It's just a question of when. What should long-term investors be watching for or thinking of as far as the recession is concerned?
Well, I suppose there's always a recession on the horizon. That is true, and even though most robust economic year, there's always one down the road. But the things that we are watching are things like GDP growth or consumer confidence or durable goods orders. And candidly, the cracks are starting to form. I mean, we're starting to see some weakness. You see the leading economic indicators down, and in there was a forecast for GDP growth, which has been walked back considerably. GDP growth now is likely to come in somewhere between maybe 1.6% for the year. That is relatively weak.
It was 2.8% last year.
And that's where I'm going with this, is that in the 1% range, that level of GDP growth is weak to the point where it leaves us vulnerable to shocks, can push us into a recession. So it's something we're cognizant of and paying attention to.
And I think, Jolie, to remember, too, is it's not just what we know when we're following these indicators and things that we can measure. Don't forget that of the major sell-offs that have happened in the last 50 years, a handful of them nobody saw coming. Right. Think of 9/11. I mean, it's impossible to predict. Things like even the financial crisis, very few economists or anybody else called that one accurately. So that just speaks to the importance of the balance in your portfolio, because you can't predict everything. Some things come from a meteor from outer space, I'll call it, and you have to be prepared for that moment.
I'll call out my colleague Steve Giles, who wrote an article recently about just rebalancing. And I think now's a wonderful time to just take a practical and pragmatic look at your investment account. If you haven't done rebalancing in a while, take a look at what has done really well and maybe trim and take some gains and find some other areas of the market like bonds and cash that are offering some competitive yields to stock these days, and do some just rebalancing if you haven't done so in a while.
Thanks. And just a tease for next week, we've actually got for economic reports, we've got a slew of them. We've got the consumer confidence, what you were mentioning, Adam, the GDP, the gross domestic product, which is the big measure of the total economy. We've got the jobs report on Friday. So there are a lot of things coming up that help feed into the Fed's decisions on when to lower interest rates again or potentially to raise them again. Anything else? Anything you're looking forward to in the next week? Anybody going to the Cubs-Brewers games?
Love to see the Brewers make a big statement coming into that Cubs series. That would be something else.
Go Brewers.
With that, thanks for listening, and we'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.